guys, welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio, and today we're going to be kind of talking about Tattooed Chef, what's kind of going on with Tattooed Chef, as well as some other things that we've been noticing online regarding its gross profit at the moment. We're going to be kind of like walking you guys through how the market is sort of responding to Tattooed Chef, as well as some recent developments by TTCF. So without further ado, what are we looking at here today?
Yeah, so we're basically kind of doing an update because once we start talking about not an investment, because we're not invested in it, but a particular stock, and then we get community feedback, and then sometimes people ask for follow-ups on these investments, and we're obliged to then do so. So Tattooed Chef is one of those where we've spoken about in the past, and you can kind of go check out those videos on our channel, and you can see kind of what we thought originally about the company. And what we're going to do here today is kind of expand on the recent developments. So with that being said, I think it's important that we kind of look at the price action and then get a feel for how the market's responding, because they just reported their earnings. So today they're down about 6.45%. I think earnings were 2 days ago, or at least, yeah, 2 days ago.
Well, and didn't they jump recently too? They jumped by, what was it? Yeah.
So right here. So there was an initial little pop down.
Yep.
And then they popped up here. And this could be for a variety of reasons, because remember that everyone should understand this about the stock market. Mechanically, keyword mechanically, how a stock goes up and down is based on the fluctuations of buyers and sellers. And so a stock can go up for a variety of different reasons. But mechanically, how that happens is there is a greater buying pressure than selling pressure. So anything could happen. So a company could not have any business fundamentals whatsoever, no revenues. They could be pre-revenue company, and the stock price can still go up because there's a greater buying pressure than selling pressure. And then vice versa, a stock could be making a tremendous amount of money. However, it could just go down because there's greater selling pressure. Over the short term, this is true. Over the long term, the fundamentals will show themselves to be, fruitful. You could say that because, for example, let's say if a company's making money hand over fist and the market prices it too low, right? You'll never find a company that is truly generating a sustainable income equal to its market cap. Well, why is that? So let's say if I came to Austin, I came to you with a business opportunity and I said, you got to give me $1 million. And every year the company's, going to grow, let's say 1% a year, but the income that I'm going to make from your portion, right, is $1 million, right? So you are going to make $1 million every year from here on out. Will that opportunity exist? No. You won't find that opportunity. So basically, the market doesn't allow for certain things to occur because the market is full of individual actors who are constantly seeking out deals. Okay, so you're not alone in the stock market, and the stock market or the market in general is not lacking individuals who are rational and seeking out fortunes. So therefore, it is difficult or nearly impossible to find a company, a sustainable company. That's the key word, because, okay, you could say it's $1 million and, next year it's going to go bankrupt, so you only made your money back. Then you'd say, okay, well, then that's not worth $1 million. Correct. But to say it's a sustainable company and it's going to at least last 10 years, it'll make $1 million a year and you paid $1 million. You won't find that because the market's full of rational individuals looking out for these deals. So fundamentals over time will reflect the price, because that will kind of shake itself out. And if you bought a company that, let's say, paid $1 million for it, and it only generates $10,000 a year, right? Well, you can ask yourself, how long will that take, right? So basically it's 100 PE, right? In that example. So in 100 years, if the company doesn't grow, for example, in 100 years, did you overpay for that? Well, you may not live long enough to get your money back. So you probably either the value of that investment will reflect the overall fundamentals going forward, or the market will remain in exuberance for presumably an unknown amount of time. But the assumption here is that over the longer term, while the mechanics of the investment is you are willing to pay $1 million for it, and that's what you paid for it, that doesn't necessarily reflect the actual value of that investment. right? And the value of that investment is more reflective on the results. So that little spiel there, how does it relate to Tattooed Chef? Well, Tattooed Chef may or may not have had the fundamentals to back the drop and rise. However, mechanically, you must understand that you cannot simply assume, oh, bad quarter or good quarter, therefore X result will occur, which is presumably why betting on, and I'm using that word explicitly, betting on quarterly results and fluctuations because of quarterly results is simply that, a bet. That being said, did anything fundamentally change? And I think Austin wanted to go over a quick discrepancy between the service of Seeking Alpha. You wanted to go over that real quick? Show the
Yeah,
audience?
let me actually put that on here now for everybody here on the screen. I need the ability to share my screen.
You do.
All right, let me try again. Perfect. There
That's
we go.
because I
Now
was
it's
sharing my screen.
perfect. Okay, so am I here? Can you see what I'm looking at here right now?
Yes, we can.
Okay, so basically, if you take a look at their trailing 12 months worth of data, you'll see here that right now on Seeking Alpha, it has a negative 4.2 gross profit. That's not actually the reported number. If you go over here to their quarterly, by period type, you'll see here that their gross profit is being reported on Seeking Alpha as negative 7.7. Now, this is actually rounded. This is actually their operating income. However, here it would be an operating loss. However, Seeking Alpha, there's a discrepancy in the way that this technology, this software is calculating this at the present time. Now, what's also interesting to note for the learning opportunity here, this is why it's important that if you have an investment, just as like a little like added layer, you always want to make sure that you go to the company's website to really kind of find these numbers. So with what Fabio's found here, Fabio's actually found the numbers, because the thing is that if you were just trusting this, if you saw a negative gross profit, this would probably color your investment assumption. Okay, this business is not scalable. It's caught like the revenues are costing more than the revenues that they're bringing in. Basically, it's not scalable. However, what we're trying to show here is that you always want to do one step further. You don't want to just trust everything that you're seeing right off of the first instance. You want to actually make sure that you're going into where these numbers are being sourced from, where these numbers are coming from. So now, would you show us the actual reported numbers for this? Perfect.
So gross profit for this quarter was actually 6 million rounded. And then here's where Austin was talking about the rounding of the loss from operations. Now, this is still not, I mean, depends on how you look at it, but it's not the best thing, because operating expenses, or the expenses that the company is operating, and I think based on the 10K, you know, there's so many companies we look at it, but I think I remember distinctly that in the 10K for this company, they do say that what they add onto there is the cost of shipments of the raw materials, or was it the final
basically during our first DD video, we were really talking about the stuff that we would want to see Tattooed Chef just sort of mitigating those top line costs, and why, if I was an investor in Tattooed Chef, that would be exceptionally crucial to me, and I would want to make sure that I'm seeing that here. I don't entirely have the backing to comment on if they are actually mitigating these top line costs, if they're implementing a lot of these sort of supply chain strategies. Bear in mind, Fabio, we do also have to keep in mind too, that there is a supply chain shortage right now, and there's a lot of complications that go along with that, even in other respective industries in and of itself too. So now, something else that kind of piques my interest too, when we're looking at these numbers, is if you would just pull that up for one more minute again. Basically what I'm seeing here is I'm seeing a loss from operations for the 6 months ended, or 9 months ended. I think that's 9 months ended.
It's a little smaller so everyone can see. Yep, that's 9 months.
Yep, it's 9 months ended there. I'm seeing that, at least on a preliminary overview, that there are some scaling issues with the operating expenses. But this is something that when we go into our key ratios inside of our discounted cash flow model, that will kind of provide further color to just sort of see the way that Tattooed Chef is really mitigating these top line costs. But yeah, basically, case in point.
I think for the simplicity of this video, we won't really get into that, because we did go over the key ratios in the original video. This video is kind of just the update of that.
Yeah, and okay. So basically, as a quick update, I'm still not entirely seeing this this mitigation of top line costs that I would like to see if I was an investor inside of Tattooed Chef. Now, here at Capital Mindset, we always make sure that we provide information objectively and as unbiased as possible. So that's just sort of my opinion. Is if what I'm looking at here is true, I would assume that these numbers are probably correct. But yeah, basically, case in point, make sure that if you use websites like Seeking Alpha, Morningstar, Yahoo Finance, you always kind of take that extra step to make sure that if you're invested in this company, you kind of, or if you're looking at a potential investment, you just do that one step further, just to make sure that those numbers that are reported through from that software are actually the numbers that the company itself has posted for this respective quarter or the trailing 12 months or the annual, et cetera, so forth.
For this, actually, I want to remind everyone that the model right now we're pulling up is actually the one we used in the the original video of Tattooed Chef to explain this. I think some people got confused. And we maybe did a poor job of explaining what these numbers were telling us, but the required rate of return of 27.10 is reflective of a 10x investment return over the course of 10 years. So it's 27.1% rate of return compounded over 10 years. That's why we used it. And it was based off of claims of other individuals that this company would perform in that way. So then you could see here right now, and again, we didn't assume buybacks or share dilution, that those were the growth rates we needed to assume. Go ahead, Austin.
Something that I've actually been seeing, it's this push online for the proponents of the 10x theory. They've been saying that this could be possible potentially in the issuance of a dividend, let's say. So even
I've never heard that one. That's really silly. What happened?
No, yeah, that's actually something that I had heard as well. So
wait. Okay, well, you have to explain that. That could be its own discussion. But right now, put a pin on that because I actually want to talk about that. I did not know that one. This is raw, ladies and gentlemen. This is raw. Wait, who said? You'll tell me who said that. So for example, let's assume, let's be a little less conservative, and let's say it's not going to 10x per se. So we do a 20%. I think that's like a 600% rate of return. And we can still see how the growth rates you still kind of have to assume are going to be pretty high. So we have to assume greater than 60. I think they grew at 40%. So not only am I going to have to assume growth acceleration, right? Which could be possible if you're an investor and you know that they're going to do this. We're trying to be like, just neutral here. And with this video, it's kind of like an update on our thoughts, but like also you can utilize the model in front of you and kind of see, oh, from these numbers, this is kind of what I already believe it's going to do. And I believe in the company I'm going to buy. But so the point is not for us to actually pass on our specific judgment on your investments, but for just to give our take, whether you value it or not, so 20% rate of return, I'm assuming greater than 60% growth rate. So let's actually replace that with like a 70. Okay, so you see 70, doesn't have to be that high. So that tells me that the real number at today's price is between that in order to get my 20% rate of return. And I'm assuming no dilution. So I doubt that that's going to be the case. So and I don't think they're really going to perform a lot of buybacks. I think over the next couple of years, they're going to do, let's be a little conservative and say 1% share dilution. I think that's fairly conservative as to at the stage that this company is in, what they're going to be doing. And if you have that question, I remember this creator saying that there's no point in doing share dilution if you have plenty of cash. That's definitely not true. And I can point to a lot of companies. I'll give examples like Facebook and Google were very profitable for a long time, Amazon included. And their profitability had nothing to do with them not diluting, because the dilution is all about the management deciding whether or not what is the lowest way of raising capital. Because if I'm a CFO, if I'm the CEO, I'm trying to find the cheapest ways to get the capital and then invest in the business to grow the business. So I want to find the cheapest cost of capital to lower the WACC. The WACC is the weighted average cost of capital. So if the shares are expensive, there's the investor point of view, and then there's the management's point of view. If the shares are expensive, it's probably better to raise capital that way and then use that to invest in the business. And also, you have to consider the opportunity cost, right? Because equity is being compared to debt financing. So you have debt financing and equity financing. So maybe the shares are expensive relative to, or let's say expensive from the investment point of view, but cheap versus the capital raise point of view. So when stocks are expensive from the investment point of view, they're cheap for the capital raise point of view. Okay. Because like if a stock is expensive, that's when you want to raise capital. If a stock is cheap, you don't want to raise capital because that's considered expensive. You're giving up more for less. So going back, if the stock is cheap to a capital raise point of view, then you don't want to use debt. You want to use that because maybe the debt has a higher interest rate, right? Relative, and that's like the cost of debt. So the cost of debt is higher than the stock. But you do have to also recognize that stock issuance can be very expensive over the long term, especially if you believe the company is going to do great things, right? But the point is, they can dilute you even if they're profitable, even if they have plenty of cash. It's not about that. It's about lowering that WACC and then basically generating outsized returns, okay?
Yeah.
On that invested capital. So that being said, I can see here I have to generate about between a 60 and 70% rate of return in order to justify this investment. And let's change this to 65 to see if we get closer. We're getting really close. Let's see, let's find this number. All right, almost 66, right there. So like 65, 66. Between these two numbers is where I would have to assume the growth rate on the cash flows is going to be in order to generate 600% rate of return. Let's lower these assumptions and let's do a 15% rate of return. Well, we start to see the expectations or the assumptions I have to make get a little smaller. So I still have to assume greater than 50%. Again, I'm not putting in their current growth rate here. Their current growth rate is about 40 something. We have to see acceleration is what that tells me. If you think you're going to outperform the market, let's actually see a market average return. Market average return, assuming a share dilution of 1%, which I think is conservative. I think they may do more than that, but these are just assumptions. Let's see if 40%, let's see the current 40, sorry, I said 40%, but I put 50, but you know what I meant. So the current growth rate, let's do around there. Okay, so around their current growth rate, you could assume that, and you could expect to achieve a 10% rate of return over the longer term. I'm going to move us a little here, make us a little bit awkwardly small on the screen size, because I want to really quickly check to see what that is. I have to probably expand this. Yep, I do. There we go. So that's about 159% over the course of 10 years. So for some of you may think that's not very exciting, especially hearing the rhetoric from the proponents. But that's what the fundamentals are showcasing based on those expectations. And these are based off of the assumptions. Now, of course, you can have incredible amounts of exuberance that can drive the stock price beyond what is reasonable, what is quote unquote reasonable. And that could be where you expect the returns to come from. But that's neither here or there, and that's a separate argument. Based on the fundamentals, you would, based on these growth rate expectations, that's kind of what you can expect from this business. I think that pretty much covers the update from my perspective. Austin, I don't know if you want to chime in and add some closing thoughts.
Yeah. So basically, I was just kind of finding this creator now and where they had potentially suggested that the dividend would kind of play into this. If I'm understanding him correctly, what he's saying is that past a certain point, past his thesis, that the dividends could be a potential tailwind that will help the investment 10x, that will raise the share price. That's, if I'm understanding him correctly, I think that's what his argument here is. Yes.
Do you want to tell me live who the creator is?
No, I do not
want to share that.
Nope. No.
Okay, you want to keep this individual. Okay, maybe for the best, so it doesn't. Yeah. It doesn't sound like we're roasting this person directly. That's that I don't know who it is, but yes, from that point of view, it's interesting because that person is suggesting that the dividend itself is going to be a driving force behind returns simply for the sake of the dividend. Which and it's not even it's built
off of his other hypothesis. So his hypothesis is that by 2025, it achieves, I think it's like 1 billion in revenue. And then 2028, it's 2.5 billion in revenue. And then from there, he builds his hypothesis from there. And then
Oh,
he
I know
says
which
that
creator this is. Okay, you don't even have
added,
to tell me. You just told me the
yeah,
prediction of a bill. Yeah, I know who this is. Yeah,
yeah. So then added onto that past 2028, he's talking about other potential catalysts that might affect the share price. So like what will the growth rates be, whether or not they pay a dividend, et cetera, so forth. So I was almost wondering,
No, the dividend itself is not the driver of value. The dividend itself may change the shareholder base, the expectations, but no, the dividend as itself is a form of capital return. Okay. This is for the audience. So you can see capital returns in the form of buybacks and dividends. They may change the effect it has on the valuation of your ownership percentage. Okay. So for example,
yeah.
buybacks increase your ownership percentage. If they give you a dividend and you reinvest it, not assuming or not including the effect of taxes, it basically will do the same. You reinvest it, you get more ownership percentage of the overall earnings. And that changes the valuation model of your investment over time. It can have a positive effect. Like
So
that
to
will
kind
be
of,
the driver of 10x returns.
I don't think he's saying it will be the driver of 10x returns. I think what he's saying is
The
that might be
propeller,
an
the
additional,
little, yeah, the little
a
boost.
little tiny propeller to like an overall thesis of what will drive the 10x return. The other thing that I also want to note too is just in regards to us, especially, we're not going to call out creators by name unless what we're noticing is exclusively and
Fraudulent
actually
activity.
wrong.
Yeah,
That is the
fraudulent
only
activity.
time. Because I mean, like an investment thesis that in our personal opinion
That we disagree
doesn't
with.
exactly
It's
hold, yeah, or like we don't personally disagree, like we don't personally agree with it, or it doesn't hold scrutiny under a test. That's not indicative or a reason enough of us to actually call this creator out by name. Now, if what they're doing is they're promoting penny stocks that then, you know,
don't get
completely
into it. Don't
just,
get into it.
yeah, just screw their shareholders, then yes, we will call them out
But
by name. But otherwise,
you
no,
mean their
we won't be
viewers?
calling them
They're
out.
not shareholders, viewers. They're viewers.
Yes,
Yeah.
yes, viewers. Yeah.
But like with Tattooed Chef, I mean, even the model says that it may 10x over a long period of time, but that's what I kind of am expecting. Like, let's say the 40% growth. By the way, I need to actually explain this because we can't make these videos too short because then oftentimes I don't get to explain the full thought. But these growth rates are compounded assumptions. So like, for example, here, I'm assuming 40% compounded for 10 years. That's incredible.
Yeah.
Then that's acceleration on their growth rate. And then I know that some people might be arguing, or they're getting into snacks, they're getting into this, they're getting into that. Yeah, okay. All that can be true. They can be very successful. Austin, what you gonna add?
Also, the other thing about these growth rates too is that these growth rates are predicated on cash flows as well, because I see a lot of people just exclusively saying, oh, these are predicated on revenues and revenues alone. But when you have revenues, you also have expenses, and then you have net income from there, which net income then flows into the statement of cash flows, adds back all of the non-cash expenses and the changes in net assets and well, not net assets. It adds back the changes in specific current assets and et cetera, so forth.
I
So
think I also I did forget to mention that we were actually assuming a 15% profitability rate, and I think
yeah.
that's an actually I would say an aggressive long-term assumption for a
Mhm.
food company. So if I bring it down to, I think Conagra's is like around there, maybe around like 10%. I think is where they're at. So I was being aggressive with the 15%, but so to show you, I was actually giving Tattooed Chef a big, boost
You're
in
supporting the
their,
bullish
yeah, in
thesis
the
here.
model. I was
Yeah.
actually pushing them, I was trying to say, I was trying to hype it up, Austin,
Yeah, it's
I
true.
was trying to hype
Yeah.
up the stock.
Oh yeah.
I'm trying to move the share price tomorrow.
Oh yeah.
But like I am assuming a strong compounded revenue growth rate, and then from there, predicting cash flows, that what's going to be, because it's not profitable yet, it's not even cash flow positive yet. But it, like, the model, this does say, it could 10x. Everything can kind of 10x if given enough time and continues to grow. Let's be clear. Given enough time and presuming continual growth, any individual business can 10x. Now, not excluding the effects of inflation, is that 10x a real 10x? Okay, well, that's making the argument complicated. In a simplistic argument, given enough time, if something is growing infinitely forever, even if the growth rate's really small, it will eventually 10x. So that's what I'm saying with that. I think the case for which it 10x's in 10 years, going back to the original argument about Tattooed Chef, is it's there. Obviously, it's there. The model tells us it's there. Are the assumptions that drive that occurrence valid? Is what you have to ask yourself. Remember, in the model, if you go back to that part in the video, if you scroll back right there, I remember that I'm assuming a 15% margin.
Yeah, I mean, like my conclusion with Tattooed Chef is the same as it was the first time we did this video. There's too many assumptions for me to feel comfortable investing into this personally. There's just way too many assumptions, so that's just my personal opinion.
But we could absolutely be incorrect and missing something, and you're a investor in this company. So like what we were saying before is, we're not they're here to tell you guys what's the best investment for you, what is the best investments. It's just us just discussing, right? Austin has been exploring this world, and then I work in this world. I'm obsessed with this world, and we're just talking our thoughts here. So we're not here to criticize your investment in this company or tell you you're wrong. You could be right, and we could just be missing something, and that happens all the time. Everyone has their own thesis. We're not, bullish on every single company. We're not bearish on every single company. Everyone has different agreements on where to allocate capital.
Yeah, and like there's nothing wrong. Like, we're not telling you that your investment in Tattooed Chef is wrong. I'm just saying, for me personally, we're
getting defensive here. We're getting defensive here, Austin.
Yeah,
I think we're ranted enough. Let's cut this video.
Yeah.
All right.
Well, you guys have seen it here first. If you guys have liked what you've seen today, please be sure to visit our website at capitalmindset.org. Please be sure to share the video. It really helps out the channel. And like, comment, and subscribe. We're your hosts, Austin and Fabio, and take care.